Question 1. General insurance concepts. Contract law. Which of the following statements best describes the concept of reasonable expectations as it applies to insurance contracts? A. The insured should expect that their policy will cover any loss, regardless of exclusions. B. The insurer is obligated to provide coverage even if the loss falls outside of the policy's terms. C. The policyholder's understanding of coverage should align with what reasonable person would expect from the contract language. D. The insured must interpret all exclusions strictly against themselves. Answer. C. The policyholder's understanding of coverage should align with what a reasonable person would expect from the contract language. Explanation. The reasonable expectations doctrine in insurance law states that a policyholder's understanding of coverage should match what a reasonable person would expect from the policy's terms, even if exclusions exist. Courts often interpret ambiguous policy language in favor of the insured based on this principle. Insurers must draft clear and precise policies to avoid misunderstandings. Option A. Incorrect. Insurance contracts have specific exclusions and not all losses are covered. Option B. Incorrect. Coverage is determined based on policy terms. Insurers are not obligated to cover non-covered events. Option D. Incorrect. Courts interpret ambiguous terms in favor of the insured, not against them. Relevant rule. Arkansas Insurance Code and common law principles on contract interpretation emphasize the reasonable expectations doctrine to protect policyholders from confusing or ambiguous policy language. Question 2. Scenario-based insurance regulation. Producer responsibilities. Mr. Jacobson, licensed insurance producer in Arkansas, has been approached by a new client to secure commercial property insurance policy. The client offers Mr. Jacobson large cash payment upfront to secure discount on the premium, which Mr. Jacobson accepts. However, he records only part of the payment in his official records to avoid suspicion. With following regulatory violations has Mr. Jacobson most likely committed: A. Misrepresentation of policy terms. B. Engaging in an unfair method of competition. C. Failure to maintain fiduciary responsibility. D. Offering an unauthorized rebate. Answer. C. Failure to maintain fiduciary responsibility. Explanation. Insurance producers must handle clients' funds with the utmost care, acting in a fiduciary capacity. Mr. Jacobson's action of accepting cash payment and failing to properly record it violates his fiduciary duty to manage and report client funds accurately. Producers must always ensure that payments are documented and used for the intended purpose, such as premium payments. Option A. Incorrect. Misrepresentation refers to providing false information about policy coverage, which is not the case here. Option B. Incorrect. Unfair competition refers to practices such as defamation or coercion against competitors. Option D. Incorrect. Rebating involves offering discount or incentive that is not allowed by law, but this scenario is more about mismanagement of funds. Relevant rule. Arkansas Code SS 2364502 outlines producers' fiduciary responsibilities in managing client funds. Question 3. Property and casualty insurance. Automobile insurance. An insured driver in Arkansas is involved in an at-fault accident causing $10,000 in property damage to another vehicle if the insured has the minimum required liability limits under Arkansas law. How much of this claim will their insurer cover? A. $25,000. B. $10,000. C. $15,000. D. $5,000. Answer. B. $10,000. Explanation. Under Arkansas state law, the minimum required liability limits for property damage coverage are $25,000 per accident. In this case, the insured's liability coverage will fully cover the $10,000 property damage claim because it falls within the minimum required limit. Option A. Incorrect. This is the total liability limit for bodily injury per person in Arkansas, not property damage. Option C. Incorrect. This amount does not correspond to any minimum coverage requirement under Arkansas law. Option D. Incorrect. Arkansas law requires $25,000 minimum coverage for property damage liability, making $5,000 incorrect. Relevant rule. Arkansas Motor Vehicle Liability Insurance Requirement, Arkansas Code SS 2722104, specifies minimum liability limits for both bodily injury and property damage as follows: $25,000 for property damage, $25,000 bodily injury to one person, $50,000 for bodily injury to two or more people. Question 4. Underwriting principles. Sources of underwriting information. Which of the following sources of underwriting information provides the most objective and verifiable data about an applicant's health history? A. The producer's report. B. The application submitted by the applicant. C. The Medical Information Bureau (MIB). D. The attending physician's report (APA). Answer: D. The attending physician's report (APRA). Explanation: the attending physician's report (APA) provides objective and verifiable data regarding an applicant's medical history directly from the doctor who treated the applicant. This source is considered more reliable than self-reported information or summaries from the producer. Option A. Incorrect. The producer's report reflects the producer's observations but lacks detailed health history. Option B. Incorrect. The application contains self-reported information which may be inaccurate or incomplete. Option C. Incorrect. The Medical Information Bureau (MIB) provides coded data about past insurance applications but does not contain comprehensive medical details. Relevant rule: underwriting guidelines require insurers to use objective sources to reduce the risk of adverse selection and fraud. Question 5. Scenario-based. Marketing practices. Unfair claims practices. Mrs. Reynolds files claim with her home insurance company after her roof is damaged by storm. The insurer delays processing the claim for more than 90 days and provides no valid reason for the delay. The insurer also fails to provide Mrs. Reynolds with updates about her claim status. Which of the following unfair claims practices has the insurer committed under Arc? A. Misrepresentation of policy provisions. B. Failure to acknowledge and act promptly on claim. C. Offering settlement that is less than the policy limit. D. Failure to pay the claim due to policy exclusion. Answer: B. Failure to acknowledge and act promptly on a claim. Explanation: the insurer's actions constitute an unfair claims practice under Arkansas law by failing to act promptly on a claim without providing a valid reason for the delay. Insurers are required to acknowledge claims quickly, conduct investigations in a timely manner, and keep claimants informed throughout the process. Option A. Incorrect. There is no indication that the insurer misrepresented any policy terms. Option C. Incorrect. The scenario doesn't mention any settlement offers. Option D. Incorrect. The delay isn't due to policy exclusion, but rather poor claim handling. Relevant rule: Arkansas Code SS 2366206 outlines unfair claims practices, including the requirement for insurers to acknowledge and process claims promptly. Question 6. Federal laws and regulations. Fair Credit Reporting Act. Under the Fair Credit Reporting Act, FCRA, if an insurer denies an applicant's policy based on information in their credit report, what must the insurer provide to the applicant? A. Copy of the applicant's credit report. B. The name of the credit reporting agency that provided the report. C. List of all negative items in the credit report. D. The applicant's credit score. Answer: B. The name of the credit reporting agency that provided the report. Explanation: the FCRA requires insurers to inform applicants if an adverse action is taken based on their credit report. The insurer must provide the name and contact information of the credit reporting agency used, along with a notice of the applicant's rights under the FCRA. Option A. Incorrect. Insurers are not required to provide the actual credit report. Option C. Incorrect. Insurers are not required to list specific negative items. Option D. Incorrect. The applicant's credit score is not required to be disclosed by the insurer. Relevant rule: 15 U.S.C. SS 1681 meters governs the disclosure requirements under the Fair Credit Reporting Act. Question 7. Property and casualty insurance. Homeowners coverage. Which of the following perils is typically excluded from standard homeowners insurance policy Hothery unless additional coverage is purchased? A. Fire damage. B. Windstorm damage. C. Earthquake damage. D. Theft of personal property. Answer: C. Earthquake damage. Explanation: a standard homeowners insurance policy Hothery covers fire, windstorm, and theft but typically excludes earthquake damage. Homeowners must purchase separate earthquake insurance or an endorsement to be covered for this peril. Option A. Incorrect. Fire damage is covered under a standard Hothery policy. Option B. Incorrect. Windstorm damage is covered under a standard Hothery policy. Option D. Incorrect. Theft of personal property is covered under a standard Hothery policy. Relevant rule: either Hothery policy form outlines the standard coverage and exclusions in homeowners insurance policies. Question 8. Specialized health insurance for qualified individuals. Medicare, which part of Medicare covers hospital inpatient care, skilled nursing facility care, hospice care, and some home health services. A. Medicare Part A. B. Medicare Part B. C. Medicare Part C. D. Medicare Part D. Answer A. Medicare Part A. Explanation. Medicare Part A provides coverage for hospital inpatient care, skilled nursing facility care, hospice care, and some home health services. It is also known as hospital insurance. Option B, incorrect. Medicare Part B covers outpatient care, doctor visits, and preventive services. Option C, incorrect. Medicare Part C refers to Medicare Advantage plans which offer an alternative to Parts A and B. Option D, incorrect. Medicare Part D covers prescription drugs. Relevant rule: Medicare Program Regulations 42 CFR Part 409 provide detailed coverage information. Question 9. Insurance regulation. Licensing requirements in Arkansas. Temporary insurance producer license can be issued to an individual under which of the following circumstances? A. The applicant has completed 50% of the pre-licensing education requirements. B. The applicant's employer has submitted an endorsement letter. C. The applicant is the spouse of deceased licensed producer. D. The applicant has been convicted of misdemeanor related to insurance fraud. Correct answer, C. The applicant is the spouse of a deceased licensed producer. Explanation: in Arkansas, a temporary insurance producer license may be issued to the spouse, next of kin, or legal representative of a deceased or disabled licensed producer to allow them time to complete the business transactions. A temporary license is issued for a limited period. Option A, incorrect. Completing pre-licensing education does not qualify someone for a temporary license. Option B, incorrect. An employer's endorsement letter is not sufficient. Option D, incorrect. Criminal conviction disqualifies an applicant from receiving any license. Relevant rule: Arkansas Insurance Code SS2364508 outlines the conditions for issuing temporary producer licenses. Question 10. Health insurance. Policy provisions. Which of the following is considered mandatory policy provision under Arkansas health insurance regulations? A. Free look provision. B. Grace period. C. Coordination of benefits. D. Change of occupation. Answer B. Grace period. Explanation. A grace period is a mandatory provision that requires insurers to allow policyholders a specified period of time after the premium due date to make their payment without losing coverage. This protects policyholders from inadvertent lapse in coverage. Option A, incorrect. The free look provision is optional, not mandatory. Option C, incorrect. Coordination of benefits applies to group health plans, not individual policy provisions. Option D, incorrect. Change of occupation is a discretionary provision. Relevant rule: Arkansas Code SS2379108 requires specific mandatory provisions in health insurance policies. Question 11. Insurance basics. Insurable interest. Where must insurable interest exist for property insurance policy to be valid? A. At the time of application only. B. At the time of loss only. C. At both the time of application and the time of loss. D. It is not required for property insurance. Answer B. At the time of loss only. Explanation: in property insurance, insurable interest must exist at the time of the loss to ensure the policyholder suffers a legitimate financial loss. Without insurable interest, the insurer would not compensate the policyholder. Question 12. Policy provisions. Coinsurance clause. Building insured under commercial property policy has coinsurance clause of 80%. The building is valued at $500,000, but the policyholder insures it for only $300,000. Covered loss occurs, causing $100,000 in damages. How much will the insurer pay assuming no deductible? A. $60,000. B. $75,000. C. $80,000. D. $100,000. Answer B. $75,000. Explanation: the insurer will pay based on the coinsurance formula. Amount carried, amount required x loss amount. 300,000 were 500,000 x 0.8 x 100. This is equal 75,000. Question 13. Arkansas insurance laws. Producer licensing in Arkansas. How often must licensed insurance producer complete continuing education? C. Requirements. A. Every year. B. Every 2 years. C. Every 3 years. D. Every 5 years. Answer B. Every 2 years. Explanation. Arkansas requires licensed insurance producers to complete continuing education every 2 years to maintain their licenses. Question 14. Liability insurance. Comparative negligence under Arkansas modified comparative negligence laws. Plaintiff can recover damages as long as their degree of fault does not exceed A. 25%, B. 33%, C. 49%, D. 50%. Answer D. 50%. Explanation. In Arkansas, the plaintiff can recover damages under modified comparative negligence if their fault is 50% or less. If their fault exceeds 50%, they cannot recover damages. Question 15. Auto insurance. Uninsured motorist coverage in Arkansas. Which of the following is true regarding uninsured motorist coverage? A. Coverage is mandatory in all auto insurance policies. B. Coverage is offered but can be declined in writing by the insured. C. Coverage is only required for vehicles used for business. D. Coverage is not available in Arkansas. Answer B. Coverage is offered but can be declined in writing by the insured. Explanation. Arkansas requires insurers to offer uninsured motorist coverage, but the insured may decline it in writing. Question 16. Property insurance. Perils covered by broad form policy. Which of the following perils is not covered under standard broad form? HO2 homeowners insurance policy. A. Fire. B. Hail. C. Flood. D. Vandalism. Answer C. Flood. Explanation. Flood damage is excluded from most standard homeowners insurance policies, including HO2, and requires a separate flood insurance policy. Question 17. Business owners policy. Eligible businesses. Which of the following businesses would not be eligible for business owners policy? B. A retail store. B. Small restaurant. C. Manufacturing facility. D. An apartment building. Answer C. A manufacturing facility. Explanation. Manufacturing facilities are typically not eligible for a BOP because of their higher risk and specialized insurance needs. Question 18. Health insurance. Guaranteed issue. Under the Affordable Care Act, health insurance policies offered on the marketplace must be A. Guaranteed renewable. B. Guaranteed issue. C. Community rated. D. Experience rated. Answer B. Guaranteed issue. Explanation. The account requires that health insurance policies be guaranteed issue, meaning insurers cannot deny coverage based on pre-existing conditions. Question 19. Property and casualty. Liability limits. If policy lists liability limits as 100, 350, what does the 50 represent? A. Maximum coverage per person for bodily injury. B. Maximum coverage per accident for bodily injury. C. Maximum coverage for property damage per accident. D. Deductible amount for property damage claims. Answer C. Maximum coverage for property damage per accident. Explanation. The third number in a split limit liability policy represents the maximum property damage coverage per accident. Question 20. Flood insurance. Waiting period. What is the standard waiting period for National Flood Insurance Program NFIP policy to take effect after purchase? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer C. 30 days. Explanation. The standard waiting period for the FIP policy is 30 days, except in cases of lender-acquired coverage or map revisions. Question 21. Arkansas insurance laws. Penalties for unauthorized insurance transactions. If an individual conducts insurance transactions in Arkansas without valid license, the commissioner may impose which of the following penalties? A. Warning letter without fines. B. Fine of up to $500 per violation. C. Fine of up to $1,000 per violation and possible imprisonment. D. Immediate revocation of all licenses in every state. Answer C. A fine of up to $1,000 per violation and possible imprisonment. Explanation. In Arkansas, conducting insurance transactions without a valid license can result in a fine of up to $1,000 per violation and possible imprisonment. The Commissioner has authority to enforce strict penalties to ensure compliance with licensing laws. Question 22. Health insurance, small group coverage requirements under Arkansas law to qualify as small employer eligible for group health insurance coverage. Business must have at least 2 employees, but no more than 50 employees. B, at least 1 employee, but no more than 25 employees. C, at least 10 employees, but no more than 100 employees. D, at least 5 employees, but no more than 7 employees. Answer A. At least 2 employees, but no more than 50 employees. Explanation. According to Arkansas insurance regulations, a small employer is defined as a business with 2 to 50 employees. This classification determines eligibility for small group health insurance plans under state and federal laws. Question 23. Auto insurance. Arkansas minimum liability limits. What are the minimum liability limits required for auto insurance in Arkansas? A. $15,000 per person, $30,000 per accident, $5,000 property damage. B. $20,000 per person, $40,000 per accident, $10,000 property damage. C. $25,000 per person, $50,000 per accident, $25,000 property damage. D. $30,000 per person, $60,000 per accident, $15,000 property damage. Answer C. $25,000 per person, $50,000 per accident, $25,000 property damage. Explanation. In Arkansas, the minimum auto liability insurance limits are $25,000 per person, $50,000 per accident, and $25,000 for property damage. This ensures that drivers have sufficient coverage for injuries and property damage they may cause in an accident. Question 24. Scenario question. Fiduciary responsibilities. Amanda is licensed insurance producer in Arkansas. She collects premium payment from client but delays submitting the payment to the insurer for over a week, instead using the funds temporarily for personal expenses. What legal issue is Amanda most likely to be violating? A. Misrepresentation of policy terms. B. Breach of fiduciary duty. C. Rebasing. D. Unfair discrimination. Answer B. Breach of fiduciary duty. Explanation. Producers in Arkansas act in a fiduciary capacity, meaning they have a legal obligation to handle clients' money responsibly. Amanda's actions constitute a breach of fiduciary duty because she used client funds for personal purposes instead of forwarding them to the insurer promptly. Question 25. Underwriting principles. Medical Information Bureau. What is the primary purpose of the Medical Information Bureau in underwriting? A. To determine premium rates based on geographic location. B. To provide detailed medical histories of applicants to insurers. C. To maintain database of applicants' credit scores. D. To ensure applicants are offered coverage regardless of their health status. Answer B. To provide detailed medical histories of applicants to insurers. Explanation. The Medical Information Bureau (MIB) helps insurers share and access information about applicants' medical histories to prevent fraudulent applications and improve underwriting accuracy. Question 26. Property insurance. Replacement cost versus actual cash value. Which of the following best describes the difference between replacement cost (RC) and actual cash value (SEVA)? SEV considers depreciation while RC does not. B. RC considers depreciation while SEV does not. C. RC is only used for commercial policies while SV is used for personal policies. D. CV and RC are calculated the same way. Answer. SCV considers depreciation while RC does not. Explanation. Replacement cost RC provides coverage to replace damaged property without considering depreciation. In contrast, actual cash value CV deducts depreciation from the replacement value to determine the payout. Question 27. Marketing practices. Rebating. Which of the following is an example of rebating which is prohibited in Arkansas? A. Producer offers potential client lower premium than what is filed with the state. B. Producer sends birthday card to client annually. C. Producer offers client discount on their first premium payment in exchange for referral. D. Producer hosts seminar about insurance products at no cost to attendees. Answer. C. A producer offers a client a discount on their first premium payment in exchange for a referral. Explanation. Rebating occurs when a producer offers something of value that is not specified in the policy, e.g. a discount or gift as an inducement to purchase insurance. This practice is illegal in Arkansas. Question 28. Fair Credit Reporting Act. Adverse action notice. Under the Fair Credit Reporting Act of CRA, if an insurer takes adverse action based on information in consumer's credit report, the insurer must A. Notify the credit reporting agency immediately, B. Provide the consumer with an adverse action notice, C. Reassess the consumer's application within 30 days, D. Reduce the consumer's premium as compensation. Answer: B. Provide the consumer with an adverse action notice. Explanation: the FCRA requires insurers to notify consumers of adverse actions taken based on their credit report. The notice must include the name of the credit reporting agency and the consumer's right to dispute the report. Question 29. Federal laws. 18 USC sections 1033 and 1034. Which of the following individuals would need to apply for 1033 waiver to work in the insurance industry? A. An applicant with suspended driver's license. B. An applicant convicted of felony insurance fraud. C. An applicant who failed to complete continuing education requirements. D. An applicant with minor traffic violation. Answer: B. An applicant convicted of felony insurance fraud. Explanation: under 18 USC sections 1033 and 1034, individuals convicted of felonies involving dishonesty or breach of trust must obtain a 1033 waiver to work in insurance. Question 30. Consumer-driven health plans. HSAS versus FSAS. Which of the following statements is true regarding health savings accounts, HSAS, compared to flexible spending accounts, FSAS? A. Both HSAS and FSAS are only available to individuals with employer-sponsored insurance. B. FSAS require high-deductible health plans, while HSAS do not. C. HSA contributions are tax-deductible, while FSA contributions are not. D. HSAS allow unused funds to roll over annually, while FSAS generally do not. Answer: D. HSAS allow unused funds to roll over annually, while FSAS generally do not. Explanation: health savings accounts, HSAS, allow individuals to roll over unused funds from year to year, whereas flexible spending accounts, FSAS, typically have a use it or lose it policy with limited rollover options.